Hello, I'm Rick Underwood, and this is David Walterman. We are with the Reverse Mortgage Group.
Yes, we are.
And today's question is, could I use a reverse mortgage to, make improvements to my home?
Home remodel. Yes, you can. That
Okay.
is the quick, simple answer. We're going to kind of dive into a real world scenario. And this couple has decided that they need a new roof. So at this point of needing access to quite a bit of cash,
It's a big
expense
ticket item.
Yeah. So typically the first place people look is a home equity line of credit. So they draw out the plans of that. They realize the qualifications, and then the really drawback to this is the monthly payment it's going to create.
Yes, and especially you're a little bit older. Maybe at this point you paid off your mortgage, so the idea of taking out another mortgage or having another payment is not the most attractive thing. And
Right.
So exactly that. So
The other option that they realize or that they've heard about is a reverse
Yes.
mortgage.
Yes.
So let's draw a distinction between a HELOC and a reverse mortgage. What is a reverse mortgage, and
Sure.
why is
sure.
it a
And
better
most
option?
most people are familiar with a HELOC or a home equity line of credit, and it's typically a second mortgage that goes behind your first mortgage, but it's a line of credit that you can use however you like, but you have to make a mortgage payment and service that every month.
Yeah.
And so when you're at that life stage, maybe you things are a little bit tighter or you're on fixed income. The idea of that is less attractive once you look into it and see the numbers and see you have to make a payment. So a reverse mortgage is fantastic for a case such as this. With a reverse mortgage, you're able to tap into some of the equity in your home and not make a mortgage payment.
Say that last part again.
You get to tap into a portion of the equity in your home and not make a mortgage payment.
Not make a mortgage
Which
payment.
is huge. So a lot of people think, wait, how the heck does that work? Which we'll get into, but yeah.
Yeah, but let's also talk about the distinction between qualifications on a
Yes.
HELOC versus a reverse mortgage.
Big
A
difference.
reverse mortgage is very easy to qualify for.
Right.
What are those
Right.
qualifications?
So once again, with a line of credit, the bank's going to want to see income, assets, tax returns. All kinds of things that nowadays with guidelines the way they are, it's a little tougher to qualify, especially if you're on fixed income.
Yeah, once you're retired and on that fixed income, then you might not qualify for it.
And if you had a lot of assets, you wouldn't be taking out a line of credit. So it can be tough. On a reverse mortgage, it's very easy. With a reverse mortgage, there are really three requirements. One is age. You need to be 62 years or older. You need to live in your home, and you need to have equity in your home.
So they check all three of those boxes.
Right.
So
And that really is it. It's really
they're
pretty
qualified.
simple. Yeah.
And we like to state that the bank also wants to see you've got enough income to continue
Yes.
making your property tax payment and your homeowner's insurance, which you're going to do regardless.
On any mortgage.
Right.
Mortgage. And with that, even if they don't have enough money coming in, we can always set up what's called an impound account, where it's paid out of their
Yes.
line of credit or out of their reverse mortgage even, but that's a different topic. So yes.
Okay. What I think is funny about this story is this couple is deciding, man, we need a new roof. Our house is just to that point. And then they realize that their house is pretty boring. And the reason this
Yes.
even comes into their mind is because they've got grandkids now.
Yes.
And they need a way to lure these grandkids over to the house more
Yeah.
often.
So for years, they've been content to sit in the backyard and watch the birds and read the newspaper, but that's not that
anymore.
exciting for the
No.
grandkids. Yeah.
So
They've tried to get them into bird watching, and it hasn't clicked. Yeah.
So along with this new roof, now they've decided, hey, let's build a backyard paradise.
Yeah.
Let's put in the pool. Let's put in the outdoor kitchen.
Oh, sure.
So now their roof has, gone from costing $40,000 or $50,000 to now they need about $175,000.
Right. Because they're dreaming. They're thinking, oh my goodness. We do have access to this equity. Let's use it. It's only going to increase the value of our home anyway.
Right.
And when you're looking at a new roof, I always equate it. It's kind of like getting tires for your car. Like it's necessary, you need them, but it's not very exciting.
Yeah.
I'd much rather get a new paint job.
Right.
Yeah.
Exactly. So in their case, they've determined they talked with the contractor for both the roof and the backyard remodel, and they're going to need $175,000. So let's see how their numbers play out.
Sure.
Their age is 72. And there's three factors that the bank uses to calculate how much cash is accessible to the homeowner. It's the age, it's the home value, and the zip code because of lending limits.
Sure.
So in their case, they're 72 years old. They live in Pasadena in a home that is worth $1.5 million. We put it down. It's actually worth $1,562,000 to be exact. And they don't have a mortgage balance.
Right.
Zero balance there.
Which is terrific. And like I said, so often you get to that point and you're like, oh my goodness, I don't necessarily want to take on another mortgage of any kind at this point.
Yep.
Right.
So again, their goal was $175,000. When we plug in their age and the home value, I might add that lending limits for this county are about $1 million, $1,089,200 or something.
And what that means is FHA will insure that much.
Yes.
Regardless of what the home is worth, FHA is saying, well, you know what? This is the maximum we're going to insure, a little over $1 million.
So instead of the factoring being based on that 1.5 million, it's really based on the 1 million mark of the
$1,089,000
county loan limit. So the bank is giving them access to, it's called a principal limit, and the amount is $441,166.
So let's do this. I think the best way to illustrate this is with a house.
There it is. Beautiful house.
There it is. Now they have a builder. I could probably use a better builder, but this is my house. Yes. So sorry, what was the amount?
1 million. Their home value is 1,562,000, and the principal limit amount that they have access to is 441,166.
I'm going to round these.
Okay.
441.
Yep.
Okay, so based upon a value of 1.562, which for FHA guidelines, they're going to actually say that's $1.8 million.
Right.
Just so these numbers make sense. So if that's the case, the bank is saying, you know what, if that's the value, if you're 72 years old, we're going to allow you to tap into $441,000 in that home.
Yep.
We'll give you the access to that much cash.
And as we've mentioned before, the beautiful part of a reverse mortgage is you're not making a mortgage payment.
Right.
So explain how this magic works.
Right. So with that being the case, on a conventional mortgage, if you get a cash out refinance for $441,000, that next month you're making a mortgage payment. And you're paying down that mortgage, sure, but you're paying principal and interest to pay down that mortgage. On a reverse mortgage, the exact opposite. Coincidentally, that's why they call it a reverse mortgage. So on a reverse mortgage, instead of paying down your mortgage every single month, the lender is going to assume a little bit of the equity in your home. It's an interest-only portion.
Yep.
But every single month, they're going to assume a little bit of the equity in your home. So that's how the loan is serviced.
So the loan balance is actually growing.
Sure.
But
Yep.
so is this appreciating asset
Exactly.
that you still own.
Exactly.
Right,
Exactly.
so this
you
one-
still own, and when you go to sell or refinance, it goes to your heirs.
All the equity is still yours. So this $1.5 million asset is appreciating.
Right.
You know, and it's outpacing the way that they structure these loans. It's outpacing the growth of the loan.
Without a doubt. I've never seen a case. I mean, every single time the loan balance is growing at a rate, sure, but the home is appreciating at a much greater rate. So you have more equity, stronger equity position down the road.
Yep. So in this couple's case, to help lure the grandkids in and do their roof, they only need access to $175,000 at closing.
Okay.
Okay. So what happens with the remainder of this, they take the 175 at close, and then it's an FHA loan, so there's some closing costs, the FHA insurance.
Yep.
Which you like to point out, that's what provides these safeguards.
Yes. So it's an
protection.
FHA-backed loan, which is what makes it a much safer loan than the old reverse mortgages. So an FHA-insured loan, you have mortgage insurance. It's just, but that's what provides you the protections. You can never outlive the equity. You don't have to worry about it's a non-recourse loan. They can't come after anything else. So it's a very safe, secure loan nowadays. Yep.
So here's what is fantastic about this. They take what they need at closing. The remainder of that cash is going to sit in a growing, compounding line of credit.
And so initially the bank said, sure, we'll give you access to 441. Oh, you're only going to take 175. We'll leave the rest of that in a line of credit for you.
That amount that after closing costs is going to be $231,487. So just call it $231,000.
Got it.
That line of credit that again starts compounding and growing day one. It's compounding and growing at the same rate as the loan.
Sure. And let's talk about this. Let's say they take the 175 initially and they don't even touch the line of credit that's there. If they go to sell or refinance, once again, the heirs or they still have all this equity plus that line of credit because it hasn't been touched. So all that equity is still theirs.
Yes. Yeah. And just to give an example of what happens if you just let that sit for 5 years, let's go 5 years into that line of credit. And now it is $347,000 that they have access to. And again, I like to point this out that it's as easy as making a request and you've got that cash almost immediately. And again, it's not creating.
So 231 was their line of credit initially. After 5 years, what did it grow to?
$347,000.
Wow. And that's after they've taken the 175.
Yeah.
And made the improvements. Wow.
Yep,
Okay.
made the improvements.
So that was after 5 years? Okay, just to amuse me, what about 10 years out?
Grins and giggles. 10 years out, that equity line is now $521,000 that they have access to.
Wow. Okay.
And at that point, their home is worth $2.3 million.
Oh my goodness. Right. So once again, the line of credit has grown, but the home, that appreciating asset, as it's called, considered, that has also grown.
Yeah.
So all that is theirs. Yep.
You know what that buys? A lot of hot dogs and hamburgers for the backyard cookouts.
That does. Oh, that's right.
And a lot of floaties for the pool.
Floaties.
Those are important.
Yep. So let's remember they put in the pool in the backyard. There's people swimming in there. Yeah. No. I mean, they made a lot of improvements. They probably did some more landscaping.
Little palm trees and
Actually, those are very big flowers. But yeah. Yes. Yeah. Yep. So once again, I mean, the fun part is they had this home that they'd been sitting on, all this equity they weren't tapping into. They were thinking, gosh, you know what? The kids are wanting to go here, there, everywhere. I want them at my house.
Yeah.
I want to see them swimming. I want to enjoy that. You know, why not use the equity in their home? Because even at that, they're still increasing the value of their home.
They've leveraged that equity to increase the value with this new roof and new backyard.
So the practical stuff, putting on a new roof, they may be, down the road, they may want to put in ramps or rails or something as they're aging. So they have that line of credit they can tap into at any time, but they took that 175 and they made their backyard where everyone wants to go.
Yeah. I love this
Which is awesome.
So if this kind of hits home to you and you've got grandkids that you need to give them an extra reason to come over.
Right.
Let's look at a reverse mortgage for your scenario as well. We can plug in numbers and we can let you know exactly this exact figure. We can let you know exactly how much the bank is going to give you access to.
And we don't need to dig too deep. We don't need to know Social Security number, anything like that. All we need to know is your age, zip code, and the
value of your home, and if you have a mortgage balance.
Yep, and we can look up the value, so that's easy. But with those three factors, we could tell you exactly the amount that you'd qualify and see if that meets your goals.
Yep. We'd love to answer any questions you have and plug in those numbers for you. We're here at the Reverse Mortgage Group, and we look forward to hearing from you.
Can't wait.
Signing out.